Imagine you buy a hotel with 120 rooms and a familiar national logo glowing above the entrance. The parking lot looks healthy. The lobby has people checking in. Most nights, roughly 3 out of 4 rooms are occupied. Guests may be paying something around $160 a night. At that level, millions of dollars can pass through the front desk every year. And that is exactly where hotel ownership becomes deceptive. Because the money collected at check-in is not the same thing as the money that belongs to the owner. Before you see your return, the hotel has to pay the people who clean the rooms, work the front desk, fix the air conditioners, and wash the sheets. The brand on the building may take a percentage. The reservation and loyalty systems may take more. A management company may take another fee. Then there is insurance, property tax, utilities, repairs, and debt service. And even after all of that, part of today's revenue may need to be set aside for furniture, fixtures, and the renovation the brand could require years from now. So a hotel can be busy, expensive, and apparently successful, while the owner's cash flow is much thinner than the revenue suggests. The interesting question is not, how much money can a hotel make? It is this. After everybody with a contractual claim gets paid, how much of one occupied room is actually yours? The first thing to understand is that the logo on a hotel and the owner of the hotel are often not the same company. That sounds obvious once you know it, but it changes almost every number in the business. Marriott says it owns or leases less than 1% of the properties in its global system. At the end of 2025, thousands of properties carrying Marriott-related brands were franchised, licensed, or operated under management arrangements rather than owned by Marriott itself. Hilton shows a similar structure. At the end of 2025, Hilton reported only 46 hotels in its ownership segment, while its managed and franchised or licensed systems contained thousands of properties. So when you pull into a branded hotel in an American suburb, near an airport or beside an interstate, there can be 3 separate businesses sitting on top of one another. First, there is the real estate owner. That is the party that has equity in the land, the building, and usually the furniture and equipment. That owner may also have the mortgage and ultimately carries the property's investment risk. Second, there is the brand. The brand provides the name, standards, reservation infrastructure, loyalty network, marketing systems, and access to a much larger distribution machine. In return, the owner pays fees and agrees to operate within the brand's rules. Third, there may be a management company. The owner can own the property without personally running the front desk, hiring the housekeepers, or managing room prices every morning. A third-party operator can do that job for a management fee. Sometimes the brand is also the manager. Sometimes it is not. Sometimes the owner has an internal operating company. But the important point is that ownership, branding, and operation are separate economic functions, and they can remain connected for a very long time. Marriott says its franchise agreements are generally 10 to 25 years, while its management agreements are generally 20 to 30 years. Hilton says new hotel franchise agreements are typically around 20 years, while conversions are generally around 10 to 20 years. That means choosing a flag is not like choosing the soap in the bathroom. It can shape the economics of the property for a large part of its investment life. From the owner's perspective, this creates the first trade-off. A strong brand may help fill rooms, give the hotel access to a large loyalty base, and make the property easier for travelers to recognize. But the owner is buying that distribution with money and with control. The stronger the system around the hotel, the more rules and contractual claims may sit between gross revenue and owner cash. And that is why buying a hotel is not simply buying a building with beds inside it. You are buying real estate, an operating business, and a long-term relationship with a distribution network at the same time. The next problem is that these 3 pieces are financed against a product with an unusually short shelf life. A normal apartment landlord can lose a prospective tenant today and still rent the apartment next week. A hotel owner cannot save tonight's empty room and sell it twice tomorrow. At midnight, the inventory expires. That single fact makes hotel real estate behave differently from a passive lease. An owner entering the business has several possible routes. You can buy an existing branded hotel and inherit an operating history. You can acquire an independent hotel and convert it to a brand. Or you can develop a new hotel from the ground up. Those routes can have completely different capital needs, timelines, and risks, so there is no responsible universal number for what it costs to get into the business. A 120-room hotel in one market can have little in common with a 120-room hotel in another market when it comes to land value, construction cost, property tax, labor, demand, and financing. But the routes are useful because each one moves risk to a different place. Buying an existing branded hotel gives you something a new development cannot give you on day one: operating history. You can look at how the property has actually performed, how demand changes across the year, how rooms have been priced, and how much cash the building has required. But you also inherit the building's age, its existing systems, its current brand relationship, and whatever renovation needs are already approaching. A conversion creates a different trade. You may be taking an existing independent property and attaching it to a larger reservation and loyalty network. That can change how the hotel reaches customers, but the conversion can also come with brand standards that the building must satisfy. So the owner is not simply changing the sign. The owner may be changing both the distribution system and the capital plan. Ground-up development moves the problem again. You are no longer buying an operating history because the hotel does not have one. The property has to be created before it can sell a single room. That means the owner is carrying a project before the nightly revenue machine even begins. Once the doors open, the hotel still has to build its operating rhythm, establish pricing, and turn a new physical asset into a functioning 24-hour business. None of those paths is automatically better. They simply concentrate uncertainty in different places: existing operations, conversion requirements, or development execution. Suppose, purely as an illustration, that you are buying an existing hotel. The purchase price is only the first number. You need an equity contribution. You may have acquisition costs. You need working capital. The lender may require reserves. The brand may require improvements. And if the hotel needs a renovation shortly after closing, the amount of cash you need can be very different from the number printed on the purchase agreement. That is why an owner has to ask two questions at closing, not one. What am I paying for the building? And what will the building require from me after I own it? Those are not the same question. Then comes debt. Debt can make a good property more attractive to equity because you do not have to fund the entire acquisition with your own money. But debt also creates a fixed claim against a business whose revenue can move every night. The mortgage payment does not care that Tuesday was slow. The lender does not reduce principal because a convention canceled. Interest does not disappear because a competing hotel opened nearby. Public hotel owners show how important this can become. RLJ Lodging Trust, for example, reported that more than half of its indebtedness was variable rate at the end of 2025 before considering the effect of hedges. Its filing also quantified how a change in market interest rates could affect earnings and cash flow. That is not evidence that every individual hotel uses the same financing. It is evidence that interest rate exposure is a real concern for owners of hotel real estate. Maturity risk matters too. A property can be operating normally and still face a difficult moment when a loan has to be refinanced. If the new loan costs more, offers less leverage, or requires additional equity, the owner may have to inject cash even though guests are still checking in every night. This is one of the central tensions of the hotel business. Revenue is repriced daily. Debt is not. The rooms reset every night. The capital structure stays with you. So before deciding whether the financing is safe, an owner needs to understand the numbers that describe room performance. And one of the easiest mistakes is believing those numbers describe profit. Hotels are usually discussed through three basic operating metrics: occupancy, average daily rate, and revenue per available room. Occupancy is the percentage of available rooms that were sold. Average daily rate is room revenue divided by rooms sold. Revenue per available room combines the two. A simple way to calculate it is occupancy multiplied by average daily rate. These numbers are useful because they tell you how well the room inventory is being sold. They do not tell you how much money the owner keeps. For a real-world reference point, Apple Hospitality's comparable hotels averaged 74.1% occupancy in 2025, an average daily rate of $159.09, and revenue per available room of $117.95. That is one public company's portfolio, not the average for every hotel in America, but it gives us a reasonable anchored example of the scale of the room math. Now apply roughly similar numbers to an illustrative 120-room hotel. If 75% of those rooms are sold on an average night, that is 90 occupied rooms. At an illustrative average daily rate of $165, the property generates about $14,850 in room revenue per night. Multiply that across a full year, and room revenue is a little over $5.4 million. That sounds like a substantial business, because it is a substantial business. But $5.4 million of room revenue is not $5.4 million of owner income. It is not even the complete revenue picture. Depending on the property, there may be parking, food and beverage, meeting rooms, or other sources of revenue. And depending on the property, those extra sources can also create extra costs. More importantly, revenue per available room only measures room revenue. RLJ explicitly describes average daily rate, occupancy, and revenue per available room as operating performance measures, and notes that the rate and revenue per available room metrics include only room revenue. In RLJ's 2025 portfolio, room revenue represented about 81% of total revenue. So when someone tells you a hotel's revenue per available room, you still do not know total revenue. And when someone tells you total revenue, you still do not know profit. This distinction matters because the hotel can improve one visible metric while the owner's economics deteriorate somewhere else. Imagine occupancy rises because the hotel cuts price aggressively. The building looks busier, but the average daily rate falls. Imagine the average daily rate rises because the hotel sells fewer rooms at higher prices. Rate looks stronger, but occupancy falls. Imagine revenue per available room improves modestly, while wages, insurance, or interest expense rise faster. The operating metric can move in the right direction, while owner cash moves in the wrong direction. There is another subtle point. Selling one more room is valuable, but it is not free. A sold room may require cleaning. It consumes linens, supplies, and utilities. It can carry reservation system costs. It increases wear. RLJ describes room expenses as including housekeeping and front office wages and payroll taxes, reservation systems, room supplies, laundry, and other room-related costs. The company also says occupancy is a major driver of room expense. This is where hotel pricing becomes operational rather than theoretical. A manager does not simply ask, "Can I sell this room tonight?" The better question is, at what price does selling this room improve the economics of the property? If the hotel discounts too aggressively, it can create more cleaning, more laundry, and more wear while contributing too little toward the fixed costs behind the building. If it prices too high and leaves too many rooms empty, that unsold inventory vanishes forever at midnight. So the ideal room is not simply a sold room. It is a sold room at a rate high enough to cover the variable cost of serving that guest and contribute enough money toward the enormous pile of fixed and semi-fixed costs waiting behind it. And that pile is where the business becomes much more interesting. Because every reservation can trigger a queue of payments before the owner gets to the end of the line. Start with the hotel itself. Someone has to staff the front desk. Someone has to clean the rooms. Someone has to maintain the building. Someone has to handle laundry, supplies, utilities, sales, accounting, and dozens of small operational problems that guests notice only when they go wrong. This is not theoretical labor intensity. U.S. Bureau of Labor Statistics data showed roughly 1.6 million people employed in hotels and motels on a seasonally adjusted basis in late 2025. A limited-service hotel can operate with a leaner model than a large resort, but it is still an operating business that must function 24 hours a day. And the operating bottleneck is often not one dramatic event. It is a chain of small things that must happen on time. A room has to be cleaned before the next guest arrives. A maintenance problem has to be solved before it becomes a bad review or an unsellable room. The front desk has to handle arrivals, even when demand arrives in waves. Pricing has to react to demand without simply chasing occupancy. Supplies have to be available without tying up unnecessary cash. A property can have a strong location and still leak value through weak execution. This is why hotel operations are difficult to separate from hotel economics. A broken air conditioning unit is a maintenance issue, but it can also remove a room from inventory. Slow housekeeping is a labor issue, but it can also delay check-in. Poor pricing is a revenue management issue, but it can also determine whether the same physical room sells for enough money to support the entire property. Then, add the brand. Marriott says its continuing royalty fees under hotel franchising arrangements typically range from 4 to 7% of room revenue. For certain brands, there can also be a percentage of food and beverage revenue. On top of that are reimbursements for centralized programs and services such as loyalty, reservations, and marketing. Hilton describes a similar multi-layer structure. Its franchisees pay an initial fee, then a royalty generally based on monthly gross room revenue, plus program fees for advertising and marketing, technology and reservation systems, and quality assurance. Hilton also lists other charges connected to loyalty participation, training, consultation, and procurement. So when an owner says, "My royalty is 5%, that does not necessarily mean the brand relationship costs 5%. The royalty can be only one line in a larger system bill. A public hotel owner gives us another useful view. RLJ reported that for its directly franchised hotels, royalty fees ranged from 2 to 6% of room revenue in 2025, while additional marketing, central reservation, and other franchisor costs ranged from 1 to 4.3% of room revenue. Those are RLJ's actual agreements, not a universal industry schedule, but they show why an owner's effective brand cost cannot be reduced to 1%. Now add management. If the owner hires a third-party operator, that company also needs to be paid. RLJ says its management companies generally receive base management fees between 1.5 and 3.5% of hotel revenue. Some agreements that include franchise benefits fall across a wider range, and incentive fees can apply after financial thresholds are met. Again, those are RLJ-specific contracts. The point is not that every owner pays exactly those percentages. The point is that a hotel can have one party charging for the brand and another party charging to run the property. And those two parties can have incentives that are related to, but not identical to, the owner's final return. A brand is paid for access to its system and standards. A manager is paid to operate the hotel. The lender is paid according to the financing agreement. The owner receives what is left after the structure works. That residual position is why the owner's upside can be attractive when the property performs well. But it is also why the owner is the person most exposed when several cost lines rise at once. Then come expenses that do not care what logo is on the sign. Property taxes, insurance, repairs, utilities, and other property-level costs. This is why gross hotel revenue can become a misleading headline. Look at RLJ's 2025 portfolio as a real example of the waterfall. The company reported about $1.35 billion in hotel revenue. Property operating expenses were about $888 million. Property tax, insurance, and other costs were another roughly $101 million. Its reported hotel-level operating earnings before interest, taxes, depreciation, and amortization were about $369 million. That is still a large amount of hotel-level earnings, but even that number is not the amount available to the equity owner. RLJ defines that hotel-level earnings measure as excluding interest expense, income taxes, and depreciation and amortization with other adjustments. The company separately reported more than $112 million of interest expense in 2025. That distinction is the entire episode in miniature. Revenue is not hotel-level operating earnings. Hotel-level operating earnings are not owner cash. And owner cash today is not necessarily cash the owner is free to distribute, because part of the money may already belong to the future version of the building. Hotel rooms wear out in a way that is unusually visible. Guests touch almost everything. Beds, carpet, desks, doors, plumbing fixtures, televisions, air conditioning systems, lobby furniture, and breakfast areas all age in front of customers who can compare the property with dozens of alternatives on a phone screen. A hotel that postpones reinvestment does not simply become older. It can become less competitive, earn worse reviews, and eventually fall out of compliance with its brand. That is why hotel owners reserve money for furniture, fixtures, and equipment, and it is why part of the revenue often has to be treated as money that is not really available for distribution. RLJ reports that its management, franchise, and mortgage documents can require reserves for future capital expenditures. For its hotels, these reserve requirements typically range from 3 to 5% of revenue. Again, that is a portfolio-specific disclosure, not a law governing every hotel, but it shows the mechanism clearly. If a hotel produces $5 million of revenue and 4% is being reserved for future capital work, that is $200,000 that may look like cash generated by the property, but is economically being assigned to tomorrow's furniture, equipment, and renovation. And sometimes the brand accelerates that future bill. Hilton says existing franchised hotels receive property improvement plans that must be satisfied to keep the property in compliance with brand standards and remain in the system. RLJ says that when it acquires a hotel, it often must complete a property improvement plan to bring the hotel up to the franchisor's standards. That creates a particularly important acquisition risk. You can buy a functioning hotel and discover that the real capital requirement is not simply the purchase price plus normal maintenance. The brand agreement may effectively put a renovation schedule beside the mortgage schedule. That also changes how an owner should interpret apparent cash flow before an acquisition. A property can show healthy current operations while still carrying a near-term capital obligation. If an owner looks only at the income generated by the hotel and ignores what the physical asset is about to require, the purchase can look cheaper than it really is. Public owners spend real money on this. Apple Hospitality said it invested roughly $88 million in capital expenditures during 2025 and expected another roughly $80 to $90 million in 2026, including comprehensive renovations at about 21 hotels. RLJ reported more than $126 million of capital improvements and additions during 2025. Those numbers belong to large portfolios, so they should not be divided casually into a supposed per-hotel average. Their value is simpler. They show that capital reinvestment is not an occasional accident. It is a recurring feature of hotel ownership. Then there is regulation. A hotel is a public accommodation. Under the Federal Americans with Disabilities Act, lodging operators generally have accessibility obligations, including requirements connected to accessible reservations and information about accessible features. Other requirements can vary by jurisdiction, so they cannot be reduced to one national checklist for every owner. The point is not that regulation is the largest expense in every property. The point is that hotel ownership is active compliance. The owner cannot treat the building like a warehouse and simply wait for rent checks. Guests arrive every day. Employees work every day. Systems process reservations every day. The physical asset is consumed a little every day. And eventually, all of those obligations collide with the capital structure. That is when a hotel can remain open, remain busy, and still become a bad investment for its owner. Consider a hotel that has been operating reasonably well for years. It is not a disaster property. The rooms are clean. The brand is recognizable. Occupancy is decent. The building has real value. Now, change 4 things. First, demand softens. That does not require a recession. CoStar and STR reported that U.S. hotel revenue per available room declined slightly in 2025, and demand also fell. Their early 2026 outlook noted continued pressure in parts of the select service and economy segments. Second, some costs do not fall as quickly as room revenue. You still need a front desk. You still need maintenance. Insurance does not automatically decline because occupancy did. Property tax does not reset every Tuesday morning. Management contracts and brand obligations remain in place. This is where the difference between variable costs and fixed or semi-fixed costs becomes painful. If fewer rooms are sold, the hotel may spend less on some room supplies and laundry, but the property still has to keep the building open. The lobby must function. Essential staffing remains. Systems stay online. The asset still needs maintenance. The lender still expects payment. A decline in revenue, therefore, does not guarantee a proportional decline in cost. Third, a renovation is approaching. Maybe the guest rooms have reached the point where furniture and finishes need replacement. Maybe the brand requires a property improvement plan. The owner has some money in reserves, but not enough to cover the entire project. Fourth, the loan matures. The original financing was attractive. The refinance is not. Now the hotel has 4 cash demands at once: weaker room economics, stubborn operating costs, renovation capital, and a lender asking for new terms. Nothing in that story requires the hotel to be empty. That is what makes hotel distress unintuitive from the outside. A guest can walk through the lobby and see a normal business. The front desk is staffed, the elevator works, breakfast is being served, cars are in the parking lot. But the owner's equity can be under enormous pressure because the visible operation and the invisible capital stack move on different schedules. RLJ's public disclosures illustrate the categories, not a distressed case. The company discusses interest rate sensitivity, debt maturities, capital expenditures, and the possibility that insufficient cash for debt service could force refinancing, additional financing, or delayed capital work. Those are normal risks sophisticated hotel owners monitor. This is also why hotel-level operating earnings before interest, taxes, depreciation, and amortization must be treated carefully. A property can produce positive operating earnings before interest and still leave little or nothing for equity after debt service and required capital reserves. And once equity cash flow gets thin, a relatively small change in room demand can have an outsized effect. To see why, we can build 2 hotels that are intentionally simplified. They are not predictions. They are not market averages. The purchase price, debt structure, and margins are hypothetical. The only purpose is to show how the machine behaves when a few levers move. Both owners have the same basic property: 120 rooms in a branded limited service hotel. Start with owner A. The property has stabilized. Occupancy is 75%. The average daily rate is $165. Those numbers are illustrative, but they are in the general neighborhood of the public Apple Hospitality portfolio metrics we discussed earlier. At 75% occupancy, the hotel sells an average of 90 rooms per night. 90 rooms times $165 gives about $14,850 of room revenue per night. Across 365 days, that produces about $5.42 million of annual room revenue. Now, for this model only, assume other hotel revenue adds another 10% on top of room revenue. That is a hypothetical assumption, not an industry average. Total hotel revenue becomes about $5.96 million. Next, instead of pretending we know a universal hotel margin, we choose one explicitly illustrative operating outcome. Assume this well-run property produces hotel-level operating earnings before interest, taxes, depreciation, and amortization equal to 30% of total revenue after property operating expenses, including its brand and management costs. That gives about $1.79 million of hotel-level operating earnings. Now reserve 4% of total revenue for future furniture, fixtures, equipment, and capital needs. 4% sits inside the 3 to 5% reserve range RLJ disclosed for many of its hotels, but our use of 4% here is still an illustrative assumption. That reserve is about $238,000. Now, assume annual debt service is $1 million. Again, purely hypothetical. We are not claiming that $1 million is standard for a hotel of this size. After the capital reserve and debt service, roughly $550,000 remains before owner-level taxes, corporate overhead, and other items we have not modeled. $5.96 million of revenue has become roughly $500,000 of pre-tax cash after two major owner claims. That is not a statement about whether the investment is good or bad, because we have not told you how much equity the owner invested. It simply shows how different revenue and distributable cash can be. Now look at what made owner A work. It was not one heroic number. The hotel had enough occupancy, enough rate, and enough operating efficiency for the property-level earnings to absorb a capital reserve and the assumed debt service. The business did not have to be perfect. Several parts simply had to remain inside a workable range at the same time. Now give owner B the same number of rooms, but occupancy is 62%, and the average daily rate is $145. The property now sells an average of about 74 rooms per night instead of 90. Annual room revenue falls to roughly $3.94 million. Using the same hypothetical 10% for other revenue, total revenue is about $4.33 million. Notice what happened. Occupancy fell by 13 percentage points, and the average daily rate fell by $20. Neither change sounds catastrophic in isolation, but together they removed more than $1.5 million of annual revenue from the property. Now assume operating pressure causes hotel-level operating earnings before interest, taxes, depreciation, and amortization to equal 20% of revenue instead of 30%. Again, that 20% is a scenario input, not a claimed market average. Hotel-level operating earnings are now about $866,000. A 4% capital reserve is about $173,000, and the hypothetical debt service is still $1 million. After the reserve and debt service, the result is negative by roughly $300,000 before owner-level taxes and overhead. The hotel is open. Thousands of guests stayed there during the year. It generated more than $4 million in total revenue under our model, and the equity owner still has to find cash. That is operating leverage in a very physical form. The comparison also explains why owners care so much about the interaction between rate and occupancy. If owner B tries to solve the problem by discounting aggressively, occupancy might improve, while room revenue does not improve enough to repair the cash flow. If the owner raises rates too far and loses too much demand, the same thing can happen from the other direction. There is no universal occupancy percentage where a hotel suddenly becomes profitable, because the answer depends on rate, costs, fees, capital needs, and debt. The scenarios are useful precisely because they show why a single break-even rule would be misleading. Now add a property improvement plan. Suppose the brand requires a renovation and the existing reserve does not fully cover it. We do not need to invent a typical renovation cost to understand the effect. Whatever the shortfall is, it is another equity or financing requirement arriving while the hotel is already producing weak cash flow. Or add a refinancing problem. The debt service in our example was fixed at $1 million for simplicity. In real life, the new loan could be cheaper, similar, or more expensive. The lender could offer more proceeds or fewer. The owner could be asked to contribute more equity. Now reverse the thought experiment. Suppose owner B bought the property at a much lower basis and used less debt, while owner A paid more and borrowed more. Without changing a single guest, the ranking of the two investments could change. That is why hotel ownership cannot be judged by the lobby alone. The same physical product can produce different equity outcomes because the capital structure sits underneath the operating business. The point is that hotel ownership is highly sensitive to combinations. Occupancy alone does not decide the investment. Average daily rate alone does not decide the investment. The franchise agreement alone does not decide the investment. The mortgage alone does not decide the investment. It is the interaction among room demand, rate, operating costs, brand costs, management, capital reserves, and financing that determines whether the owner has cash left. This is also why a hotel with lower revenue can sometimes be a better investment than a hotel with higher revenue. If the lower revenue property was purchased at a better basis, has less debt, requires less near-term capital, operates more efficiently, or has a more favorable fee structure, its equity cash flow can be stronger. And the reverse is true. A beautiful hotel with strong top-line revenue can be a mediocre investment if too many fixed claims sit underneath it. Which leads to a strange question. If one property already has this many moving parts, why would an owner ever want 20? Because owning multiple hotels can change the organization around the properties even when it cannot change the basic physics of a room that expires every night. One hotel is an asset. A portfolio begins to look like an operating platform. With multiple properties, an owner can centralize functions that would be expensive to build around a single hotel. Revenue management can be handled by specialists who watch prices and demand across multiple markets. Accounting can be centralized. Procurement can be negotiated across more rooms. Sales expertise can be shared. The company can build deeper relationships with lenders, brands, and management firms. A multi-property owner also gets more repetitions. Instead of seeing one renovation cycle, the organization sees many. Instead of negotiating one management agreement, it negotiates many. Instead of hiring one general manager and learning from one result, it can compare performance across a portfolio. That institutional knowledge has value. It changes what the owner can measure. With one hotel, a weak month can be difficult to diagnose because there is only one property. With multiple hotels, the company can compare locations, managers, rate strategies, maintenance patterns, and capital needs. The owner can begin separating a market problem from an operating problem because there are more internal reference points. It also changes how capital decisions are made. A single property owner may have one obvious place to spend the next dollar, the hotel they already own. A portfolio owner can compare competing uses of capital. One building may need a renovation, another may have a refinancing opportunity, another may no longer fit the portfolio, another may justify expansion because its operating performance and capital needs are stronger. The company therefore starts to behave less like a landlord with several buildings and more like a capital allocation machine built around hotel operations. But scale does not erase the local hotel. Every building still needs maintenance. Every market still has its own demand. Every property still has employees, insurance, taxes, and physical wear. And every room still expires at midnight. A larger owner can centralize some corporate functions, but it cannot centralize cleaning a room in Dallas into an office in New York. It cannot repair an air conditioning unit in Chicago from a spreadsheet. It cannot move an empty room from a weak Tuesday in one market to a sold-out Saturday somewhere else. This is an important limit to scale. Hotel companies can centralize information, purchasing, expertise, and capital allocation. They cannot centralize the physical delivery of the guest experience. That is why local execution remains a bottleneck even inside a large platform. Scale can also create new risks. A company that expands quickly can add corporate overhead faster than it creates savings. It can concentrate in markets that later weaken. It can take on more debt. It can accumulate multiple renovation cycles at once. It can sign long-term brand and management agreements that reduce flexibility. And portfolio problems can synchronize. If several properties need renovations during the same period, the organization has a capital allocation problem. If financing conditions tighten across the entire portfolio, refinancing stops being a single hotel problem. If a weak operating practice is standardized across many hotels, scale can multiply the mistake instead of fixing it. Public hotel owners demonstrate both sides. They have the scale to manage hundreds of millions or billions of dollars of hotel revenue and major annual capital programs. But their filings still spend page after page discussing labor, insurance, property costs, debt, renovations, brand agreements, and demand. The problems do not disappear. They become systems to manage. That is the actual path from one hotel to a hotel corporation. The owner is no longer simply asking whether one property's occupancy is good this month. The company is deciding where to allocate capital across properties, when to renovate, which brands to use, which managers to hire, which loans to refinance, which hotels to sell, and where another dollar of equity has the best risk-adjusted use. The owner also gains one thing that is easy to underestimate: optionality. A single hotel owner has one operating story. A multi-property owner can change the mix over time. It can invest more heavily where returns justify it and reduce exposure where the combination of demand, fees, debt, and capital needs no longer works. That does not guarantee a better result. It simply gives the organization more decisions to make. And more decisions create a new requirement: discipline. Scale only helps if the company can tell the difference between growth that improves the portfolio and growth that merely makes the portfolio larger. At that point, the business has changed. The building is still important, but the competitive advantage increasingly sits in capital allocation and operating discipline across many buildings. And that brings us back to the hotel in the opening. The parking lot was full. The lobby was busy. Guests were paying real money. None of that told us what the owner earned. When you buy a branded hotel, you are buying three things at once. You are buying expensive real estate that needs periodic reinvestment. You are buying a 24-hour operating business whose inventory disappears every morning. And you are entering a long-term distribution relationship with a brand that can help create demand while charging for the network and enforcing its standards. That is why the headline numbers can fool you. Occupancy tells you how many rooms were sold. Average daily rate tells you the average room rate. Revenue per available room tells you how effectively available room inventory produced room revenue. A hotel-level operating earnings measure can tell you a great deal about property-level performance before financing and certain other owner costs. But none of those numbers, by itself, tells you what the equity owner can take home after debt service and future capital needs. The owner's real business is the narrow layer left after the building has been operated. The brand has been paid, the manager has been paid, taxes and insurance have been covered, the lender has been serviced, and enough money has been preserved to keep the asset competitive. That is the paradox. A hotel can collect millions of dollars while the owner's economics depend on the last few $100,000. And that is why the best way to think about hotel ownership is not as renting rooms. It is leveraged real estate underneath an operating company, connected to a distribution network, selling inventory that expires every night. If those pieces work together, one hotel can become the foundation of a portfolio. If they do not, a full parking lot can hide a very expensive problem. The rooms are what the guest buys. The spread between everybody else's claim and the money left at the end is what the owner actually owns.